Welcome to PhillipCapital's Weekly Market Watch. In the recent week, we've seen investors taking profit from the surge in the stock market with a retracement of about 8% from this year's high of 2,283 points in the STI. This week, we discuss investing strategies investors can take in the short term. So Dexter, before we talk about investing strategies, what is the consensus outlook for the US economy?
If you look at the stock and the oil market recently, you see that prices have moved up from their March lows, and the market is probably indicating that we're going to see some good news in the near term. But if you look at the Institute of Supply Management Purchasing Managers Index in April, it was 40.1, which shows that the economy is still contracting because it's below 50. And if you look at the unemployment number, it was 8.9%, which is the highest level in 26 years. So consumption is not likely to pick up in the near term or dramatically shoot up. And given that the economy is still contracting as well as the recent boost from the market, I think the recovery is probably going to be a slow and gradual one.
Given the perception of a slow, gradual recovery, what are some of the possible strategies to employ for the near term?
I'd like to address two groups of people for this question. First, to scalpers or traders who hold short-term positions. I think selling overbought conditions moving forward makes sense. If you look at the markets, they have been heading towards the overbought rather than the oversold condition, or the condition whereby people buy too much. Within this arena, I think crosses, the Aussie crosses, especially against the greenback and the yen, is attractive from the short side. The Aussie has been propped up by investors who are attracted by the high yields as commodity exposure, but I think this is overdone. The Australian government is actually planning to issue more bonds, in fact $54 billion worth of more bonds in the next financial year, as well as raise the taxes and in fact increase the pension age. So this is likely to push down real interest rates and possibly see a lower currency. The currency may head higher in the short term, possibly the next 1 week, but I think it will be more attractive from the short side.
I assume that the next group of people will be the long-term investors. So what do you like for the longer term?
I think credit is healing in the system, and this is actually positive for high-yield bond funds. And I think investors with a longer-term outlook can consider high-yield bond funds on dips. There are a few reasons for this. First of all, LIBOR, or the London Interbank Offer Rate, is falling, and this is actually positive for credit. I expect LIBOR to fall further. Second, companies have been selling equities to raise cash, and actually raising cash is actually positive for bondholders as the assurance of receiving interest rates is higher. Thirdly, I think regulators will not allow financial institutions to fail in the same manner as what we saw with the Lehman Brothers. It's clear that the widening of credit spreads is damaging to the system, and it's unlikely to see these kind of stresses moving forward. In fact, we may see widening of credit spreads, but these are great opportunities to accumulate more high-yield bond funds for the longer term. Investors who want to look at high-yield bonds can look at unit trusts which invest in high-yield bonds for exposure.
Thank you, Dexter, for your time. That's all we have for you today. Tune in next week for more market updates.